Howdy, everybody. Welcome to Liberty Call. Today is Thursday, February 15th, 2024. My birthday. I am 50 years old today. Can you believe it? Do I look 50? I mean, maybe with all the gray in my face, but if I were to shave this off, I'd look like a young pup. Put a ball cap on, wouldn't even be able to tell. Anyways, hope you're having a good day out there. It is pretty nice here in Colorado. Not too hot, not too cold. Still way too much snow in my front yard, but what are you going to do? So we got some more snow coming, I think, tomorrow night, Saturday morning, somewhere like that. Not too much, but anyways. All righty. Well, looks like the markets were in a better mood today. The looks like the Dow was in the green all day long, and then the NASDAQ decided to finally make it back into the green here late in the day. But if it is your first time watching Liberty Call, if you could do me a favor, yes, I see you there in the purple shirt. If you could give me some thumbs up, like, share, subscribes, follows, and press that notification bell. All right, let's get into the news. Dow Jones was up 0.91%, 348 points, closed at 38,773. S&P 500 was up 0.61%, closed at 5031. NASDAQ up 0.3%, closed at 15,906. The VIX down 2.23% today. It's at 1406. Canada up 1.6%, Brazil up 0.59%, and Mexico flattish up 0.04. In Europe, Germany was up 0.6, the UK up 0.38, France up 0.86. Let's see here. Netherlands up 0.46, Spain up 0.11, Italy up 1.17%, Switzerland up 0.63, and Portugal up 0.44. Russian exchanges were mixed today. The MOEX up 0.23, the RTSI down 0.87. And the Asian markets, the Nikkei was up 1.22%, Australia up 0.77%, New Zealand up 0.84%, and all the Chinese markets were closed except for the Hang Seng, which was up 0.41%, and the Taiwan weighted up 3.03% for the day. So, all right, so that is all the markets for today. So like I said, a little bit of a bounce back from where we were, where things fell so dramatically the other day. Let's zoom in on this. As you can see, this has been the trend since, what day did that trend start? October 30th was the first positive day. And I mean, this has been very, very steep. I mean, if you look at it compared to other trends, I mean, this was almost like straight up. But we broke through the trend on that down day, which was, what was the Dow down like 500 points, 700 points, something like that. And then we've had two positive days. So I'll be curious to see if, we get back above. Let me pull this down a little bit. If we get back above this, or if, we're breaking the trend and we're going to start trending sideways or downward. So that is the, the million-dollar question right now. What is going to happen with the, with the markets? I mean, my personal belief is that we're headed towards some downward pressure just because, we've got an inverted yield curve, which has been like that for a long time. We've got, what is it? Like the PMI indexes and the, basically all the productivity indexes we look at, most of them are below 50 right now, which is a sign of contraction. So we shall see where things go, and I'll keep you abreast of what's going on. All right, let's get to today's market recap. U.S. stocks rise as energy powers ahead to offset Apple-led dip in tech stocks. All right, get to my notes here. All right, on Thursday, U.S. stocks rallied with a surge in energy stocks led by Occidental Petroleum, climbing over 4% after Warren Buffett's Berkshire Hathaway revealed an increased stake in the oil major. Occidental Petroleum also reported strong quarterly results, bolstering the energy sector. The positive momentum in the energy sector provided a counterbalance to the challenges faced by the technology sector. Tech stocks faced pressure as Cisco Systems and Deere and Company both cut their guidance, sending their shares lower. Cisco Systems down 2%, reduced its full-year guidance, and announced plans to cut its global workforce as part of a broader restructuring push. Deere & Company tumbled 5% after slashing its full-year net income outlook, signaling that elevated interest rates were affecting demand for high-priced agricultural equipment. Twilio Inc. also tumbled after issuing a softer outlook for the current quarter, with its shares falling more than 15%. On a brighter note, AI-related companies SoundHound AI and ARM Holdings saw significant gains after NVIDIA disclosed stakes in both businesses. SoundHound AI surged 64%, while chip designer ARM Holdings was up just over 5%. The investment by NVIDIA boosted investor confidence in the potential growth of these AI-related businesses. Super Microcomputer also saw a notable jump, rising more than 13% after Bank of America initiated coverage with a positive outlook, citing potential growth from AI-driven server demand. However, Apple dipped slightly after Berkshire Hathaway trimmed its stake in the company by 1%. Despite the slight decline, Apple remains a significant portion of Berkshire's portfolio, with Berkshire owning about 6% of Apple shares. Economic data showed signs of weakness in consumer spending, with retail sales slipping more than expected. The Commerce Department reported a 0.8% decline in retail sales for the month, driven largely by drops in receipts at auto dealerships and gas stations. Morgan Stanley noted that while retail sales report suggested a cooling economy, it still viewed the overall economic outlook as strong, expecting a first rate cut in June. Despite the retail sales data, the labor market continued to exhibit strength with a decrease in initial jobless claims. Initial claims decreased by 8,000 to 212,000 in the week that ended February 10th, beating forecasts of a decline. This indicated that the labor market continued to show resilience, even as other economic indicators showed signs of weakness. Amid fluctuating Treasury yields, Goldman Sachs revised down its outlook on the U.S. Q1 economic growth from 2.9% to 2.5%, citing various factors impacting economic performance. Overall, the market exhibited a mixed sentiment amid varied corporate performances and economic indicators, reflecting ongoing uncertainties in the economic landscape. All right, so it's kind of a mixed bag right now. Some things are doing well, some things are not. Companies are trimming the fat, trying to stay afloat and stay profitable. All right, let's go a little deeper into the sales numbers. Frigid temperatures chill U.S. retail sales and factory production. In January, U.S. retail sales experienced their most significant decline in 10 months, sparking concerns among economists. However, experts cautioned against overinterpretation of the sharp drop, attributing it to frigid temperatures and challenges in adjusting data for seasonal fluctuations at the beginning of the year. Despite the downturn, factors like a tight labor market and sustained wage growth suggest that consumer spending remains robust, thus supporting the ongoing economic expansion. The Commerce Department reported a notable 0.8% decline in retail sales for January, the largest since March of 23, with revisions showing lower sales figures for November and December. Economists had expected a more modest 0.1% dip for January, highlighting the unexpected magnitude of the decline. Although unadjusted retail sales typically decrease in January, the extent of the drop surpassed expectations due to adverse weather conditions and challenges in seasonal adjustment, exacerbated by the ongoing COVID-19 pandemic. I'm sorry, COVID-19 is not causing any problem. I mean, seriously, who is taking time off from work for a cold at this point? Various sectors felt the impact differently, with sales at building material and garden equipment stores, motor vehicle and parts dealers, and gasoline stations experiencing notable declines. Severe weather conditions, including snowstorms, disrupted sales activity, while freezing temperatures hampered production at factories, leading to a 0.5% decline in output. Despite these challenges, expectations regarding the U.S. Central Bank's monetary policy remain unchanged, with the Federal Reserve expected to refrain from cutting rates until at least May. So, someone in June, someone in May. They'd love it to be today, but it's not going to happen. Additionally, import prices posted their most substantial increase in nearly 2 years, signaling potential shifts in inflation dynamics. While core goods inflation may be nearing its end, implications for domestic prices remain uncertain. Amidst these developments, U.S. stocks traded higher, the dollar weakened, and Treasury prices rose. Despite the broad weakness observed in retail sales, certain sectors like food services and drinking places saw an increase, highlighting resilience in consumer spending. Economists continue to view consumer spending positively, driven by factors such as a strong labor market and rising household purchasing power. While the data suggests a softer growth trajectory, there is optimism regarding the overall economic outlook, with expectations for solid consumer spending in the coming months. We shall see. Alrighty, next up, I got an article here from Zero Hedge titled "Yield Curve Bear-Steepening Spells Trouble for Markets," and this comes from Simon White of Bloomberg Macro Strategist. All right. In Simon White's analysis, the traditional role of the yield curve as a recession predictor is called into question, with a focus instead on its utility in gauging liquidity and funding market dynamics. Rather than signaling economic downturns, the curve's movements, particularly a bear steepening where long-term yields rise more than short-term ones, are seen as indicators of potential liquidity constraints and funding stress, posing risks to risk assets like stocks. The scenario of persistent bear steepening implies that Treasury bills remain attractive to money market funds, draining reserves from the Federal Reserve's reverse repo facility and heightening the likelihood of funding pressures. Rising long-term yields exacerbate the government's interest payment burden, constraining monetary velocity and potentially unsettling markets further. The analysis highlights the impact of increasing Treasury bill issuance, which aims to prevent government borrowing from crowding out risk assets. However, it also risks intensifying funding market vulnerabilities, particularly as quantitative tightening progresses and reserves approach critical levels. White underscores the importance of monitoring three key factors: the absorption of liquidity by rising yields, liquidity attraction from the reverse repo facility, and the proximity of total reserves to scarcity. These dynamics operate over different time horizons, but collectively influence the market environment, especially for risk assets. The recent trends, such as the bear steepening of the yield curve following higher than expected CPI data, suggest a challenging liquidity backdrop and the potential for imminent funding stress. Investors are advised to rethink the conventional use of the yield curve as a recession indicator and to be vigilant regarding its implications for market stability and risk asset performance. So, I guess he's saying that, maybe the yield curve isn't the best predictor of, recessions and downturns in the economy. But up until this point, it's been pretty reliable. And with everything that's been going on, in my own personal opinion, that all the money printing of 2020 and 2021, all it did was postpone the downturn we were expecting in 2020. So, that's kind of my view on things. All right, one last article here, also from Zero Hedge, titled "Many Are Addicted to Buy Now, Pay Later Plans. It's a Big Trap." And this comes from Mike Shedlock via mishtalk.com. All right, Mike Shedlock's analysis delves into the rising popularity of buy now, pay later plans, signaling potential consumer credit stress. The Office of Comptroller of the Currency defines buy now, pay later as a short-term loans payable in 4 or fewer installments without finance charges, often offered to online shoppers at checkout. The New York Fed's research highlights how financially fragile individuals, defined by factors like low credit scores and past delinquencies, are disproportionately using buy now, pay later services at higher frequencies. While financially stable users exhibit more sporadic usage, financially fragile users embrace buy now, pay later as a regular payment option, often making medium-sized purchases outside of their budget. Excuse me. The study also reveals that while financially stable users tend to make fewer purchases and focus on avoiding interest on high-priced items, financially fragile users treat buy now, pay later more like a credit card, frequently making medium-sized purchases. Additionally, the data suggests that once consumers initiate buy now, pay later usage, they are likely to continue using it, potentially indicating further adoption in the future. However, Shedlock warns of the potential trap associated with buy now, pay later. Missing a payment could result in accrued interest from the initial purchase, turning routine purchases into long-term financial burdens. Shedlock suggests that most buy now, pay later users may be renters facing rent increases that significantly impact their financial stability, especially compared to homeowners with fixed mortgage payments. Well, not if you're paying property taxes; those go up every year. The analysis also ties buy now, pay later usage to broader trends in consumer credit stress, citing record high credit card debt and increasing delinquencies, particularly among younger age groups who are more likely to be renters. Shedlock suggests these factors contribute to the cascade of delinquencies, reflecting a broader issue of financial strain among consumers. All right, so not good. Like I said, I've said this many times. I was in the credit and collections business for a decade. And typically when, those queues start to really fill up with delinquencies, it's not usually a good sign that things are going well in the economy. So, All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. We'll put it there on the screen, DSA Financial. If you, where to go? Lost my banner. There we go. All right. Gosh. There we are. All right. So like I said, go to DSA Financial Group if you need to reach me for anything. Hope you have a wonderful evening, and I shall talk to you next time. Adios.